Today, we took another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
On Wednesday, the Federal Reserve increased interest rates by 25 basis points, raising the federal funds rate's target range to 5.25% to 5.5%. This is the highest level since January 2001. The decision was widely expected by markets, as the Fed has begun gradually tightening monetary policy in an effort to combat inflation. Despite declining from a peak of 9.1% in March, the Consumer Price Index climbed by 3% in June, significantly above the Federal Reserve's target of 2%. In a statement released after the meeting, the Fed stated that it is strongly committed to returning inflation to its 2% objective. In addition, the central bank stated that it anticipates rising rates at a gradual pace during the upcoming months. Chairman Jerome Powell stated at a news conference that although inflation has slightly decreased since the middle of last year, it has a long way to go to reach the Fed's 2% target. However, he appeared to allow flexibility for the Fed to perhaps hold rates constant at its September meeting. I would say it's certainly possible that we will raise funds again at the September meeting if the data warranted, said Powell. And I would also say it's possible that we would choose to hold steady, and we're going to be making careful assessments, as I said, meeting by meeting. Following the conference, markets initially rose, but they ultimately finished neutral. The Dow Jones Industrial Average increased by 82 points as it continued its trend of higher closings, but the S&P 500 and the Nasdaq Composite saw little change. Treasuries yields decreased. It is time for the Fed to give the economy time to absorb the impact of past rate hikes, said Joe Brusuelas, U.S. chief economist at RSM. With the Fed's latest rate increase of 25 basis points now in the books, we think that improvement in the underlying pace of inflation, cooler job creation, and modest growth are creating the conditions where the Fed can effectively end its rate hike campaign. Powell recognized that despite the Fed's swift rate increases, the economy has proven to be remarkably durable, with growth continuing and businesses continuing to create employment. He also disclosed that the staff economists at the Fed no longer expect a recession. In April, the minutes of the central bank's March meeting had said that staff economists envisioned a mild recession later this year. And he added that he continues to believe that a soft landing is still possible, in which inflation would return to the Fed's 2% target without triggering a severe recession. My base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses, the Fed chair said. We do have a shot at a soft landing. Despite the fact that inflation has slowed to its lowest level in 2 years, Wednesday's increase indicates the Fed's concern that the economy is still expanding too quickly for inflation to return to its target of 2%. Americans continue to spend money, crowding airplanes, going abroad, and going to concerts and movie theaters. Most importantly, companies continue to hire. And by the way, if you've made it this far into the video, hopefully you're finding it helpful. Make sure to subscribe and leave a like on the video so you don't miss any of my future videos related to investing and finance. According to the government, year-over-year inflation in June was 3%, a substantial decrease from a peak of 9.1% in June 2022. The Fed's preferred core inflation measurement, which does not include volatile food and energy prices, was up 4.6% in May compared to the same month last year. Powell stated that he especially appreciated the June inflation report's lower than anticipated reading, but he added that more of these types of statistics will be required to demonstrate an ongoing decline in inflation. We're going to be careful about taking too much signal from a single reading, he said. Powell stated that, we want core inflation to be coming down. Core inflation is still pretty elevated, and so we think we need to stay on task. He emphasized that the Fed's policymakers will consider a variety of new economic indicators before deciding whether to take any action, if any, at their next meeting. The last time the officials met, in June, they indicated that they anticipated double-digit rate increases. Powell pointed out that by the time they next meet on September 19 to 20, they have substantially more data at their disposal, including 2 additional inflation reports, 2 reports on hiring and unemployment, and updated statistics on consumer spending and earnings. According to some economists, the Fed may decide against raising rates in September before considering to do so at its meeting in November. Here is a graph showing you the interest rate since January 2000. In an attempt to curb inflation, the Federal Reserve has raised the benchmark federal funds rate to a level last seen 2 decades ago. Several Fed officials have expressed concern in recent weeks that the steady pace of job growth could prompt employees to demand higher wages to offset 2 years of price increases. Sharp pay increases can fuel inflation if businesses react by boosting customer pricing. The continuous easing of inflationary pressures has also given rise to optimism that the Fed can reduce inflation without a recession. Additionally, employers continued to generate jobs, creating 209,000 new positions in June, and the unemployment rate fell to a record low 3.6%. That's roughly where it was when the Fed started hiking rates in March 2022, which was a sign of resiliency in the economy that few had predicted. Some Fed officials like Lori Logan, president of the Federal Reserve Bank of Dallas, and vocal Board of Governors member Christopher Waller believe the economy has already absorbed the cumulative effects of previous rate hikes. Additional hikes, in their opinion, may be necessary to further tame price pressures, given that inflation is still above the Fed's target level. Some economists warned that the decrease in inflation year over year from over 9% to 3% was the relatively simple part. It will be more difficult and take longer to get it down to the Fed's 2% target. According to other experts, the current findings of moderate inflation may be sustained. As new apartment complexes are finished, the already reduced rate of rental cost rises should continue to decline. Though the Fed began tightening credit before central banks in many other developed countries did, the majority of them are now doing the same. In its year-long fight against very high inflation, the European Central Bank increased interest rates for the 9th straight time on Thursday. Despite growing recession fears, the bank left the door open for additional increases. The quarter percentage point increase was almost guaranteed by ECB President Christine Lagarde, who also stated that the bank's future actions would depend on the results of the statistics, notably those related to inflation and unemployment. "We have an open mind as to what the decisions will be in September and in subsequent meetings, so we might hike and hold," she told the media. Even if the bank takes a break, according to Lagarde, it would be necessary for an extended period of time. Even though she acknowledged that decisions could change from one meeting to the next, she emphasized that the ECB is very strongly rooted in our determination to break the back of inflation. Are we satisfied? Are we claiming victory? No. We want to go to the end of the game, she said. In the short term, Lagarde accepted the economic outlook for the euro area has deteriorated and would remain negative. But she added that when earnings increase and inflation declines, the economy will begin to recover. Rate increases are already having an impact. After many years of price increases, home prices have begun to fall, and business loans are at their lowest level since statistics began in 2003. Germany's construction industry forecast fell to its lowest point since 2010. Make sure to subscribe and watch the other videos on the channel for more investing and finance-related content. See you soon.